What's up, YouTube? We're going to go through Walgreens, ticker symbol WBA. We're going to look through their most recent earnings they released to us. And one of the big key points in their earnings actually is going to be this dividend cut, which I'm sure many of us and all of you are very well aware of. It's a 48% decrease to their dividend from 48 cents down to 25 cents per share. So now they're only going to be yielding about 3.9%, which is still a pretty good yield for a dividend paying company. So let's take a look at their overall financial report that they submitted and see how things are looking. So one thing we noticed the last time we looked at this company is their balance sheet was really weak. They had a lot of debt, and that's one of the things we wanted to take a peek at, is to see if things have changed or not. And well, so far we're looking at very similar cash and cash equivalents, which is, I guess it's better than going down, but they are slightly up. And we come down here to our total current liabilities. Those are up an additional $2 billion just from the last 3 months. So maybe not $2 billion, but $1.6 billion roughly there. And we can see the big contributor to that is going to be trade accounts payable. So they're not paying their, well, I guess that could be associated with the big inventory uptick as well. We got $1.2 billion in inventories. So that could be why we're seeing an increase to our trade accounts, our accounts payable. So that could be slightly irrelevant, but we are still higher than where we were prior to last quarter by quite a bit. So $26 billion in total short-term debt, but the big key component here is this litigations that they are going to have to pay here shortly. I would assume that this is going to transfer out of non-current liabilities of $6.3 billion and transfer up into current liabilities, which then they will have to pay in the next 12 months. So they'll have to pay potentially $6.4 billion in the near future, potentially, that I would assume this to transfer into current liabilities probably within the next 12 months because this is like a lawsuit, this is payments that need to get paid out. These aren't something that's going to be paid out in the next 30 years. It's going to be paid out in probably a couple lump sums in the future. So company's got to come up with about $6.4 billion here in the near future, and they've only got $784 million in cash, and obviously they got other expenses that needs to get paid for as well. So balance sheet is looking not great still. So we come down here to our income statement. In the last 3 months, company did $6.8 billion in gross profit, and SG&A expenses alone were $6.8 billion. So SG&A basically wiped out all of our gross profit. However, some of the SG&A still could be attributed to that litigations obligations, because we can see here, this is where it gets categorized under the SG&A whenever there's some sort of lawsuit, lawyer fees, all these other things. It gets put into SG&A expenses. So we can see this time last year, we're at $13 billion. So if this time last year you strip out like the $7 billion in expenses for the litigations, you can see you would have been turned a pretty nice profit on this company at about $4 billion. However, the same thing is not true for this most recent quarter. We did see more revenue. Cost of sales were up as well. Our gross profit, even with more revenue, was still not even equal to what it was last year. So we can see our margins have gone down significantly, even with more income. Nothing over here is looking good at all. Nothing promising either. Overall then, that leaves us with a negative net income. So now to our cash flows. So once we get into our cash flows, we can see down here, at least last year, we can see we added back in these litigations that were put onto our liability section. So because the cash or the company did not pay the litigations yet, it is still cash held within the company. So that is going to be a positive. So that gets added back into the cash flows. Even though we are negative here on net income, we get to add back in our litigations. So that still left us with a positive $493 million in cash from operations. This is last year. But we still had capital expenditures of $610 million. So even with, stripping that litigations out, because we technically haven't paid it, we're still negative cash flow. So even with negative cash flow, a company then had to sell some of its assets to then create some sort of cash. So they sold $2 billion worth of assets. That left them with $1.8 billion from cash provided by operating or investing activities. And then they were able to pay investors their dividend. And then we come down here and they were able to carry some of this cash over to their overall balance sheet. But another thing they're also doing is they're doing proceeds from sales. So what they're doing is they're selling their properties to investors to then lease back to Walgreens. So basically Walgreens is then now the tenant, and they just sold the property to a landlord that now bought the property. So it's a lease back transaction. So overall, some of the biggest things on any balance sheet or overall financials that you don't want to see in a business is a business that is selling its assets to come up with cash to potentially pay for a dividend, or not just potentially, but pay for a dividend and add money back to the balance sheet. So there's just a slew of red flags on this business as we just walk through the financials. It spent about 5 to 10 minutes, less than that. Obviously, I explained a lot of things, so it took a little bit longer, but 5 minutes of your time to just breeze through financials real quick to see, okay, how is this business performing financially before you even start looking into the deeper fundamentals and what the business can do. Obviously, if it's something that interests you, then that's what I would do. But so here's red flag number 1 right here. You're selling assets to come up with cash. Red flag number 1. Red flag number 2 is your negative free cash flow. Even last year, even when you add back in your litigation, so that's as if it never even happened, you add back in your litigations, you're still negative free cash flow. You don't even have cash flows to cover your dividends. So that would have been this time last year, you could have seen that and say, okay, this dividend now is at risk because we are not profitable right now, even with cash flows to pay our current dividend. So red flag number 2. And then you come up to your income statement, and you can see your negative income. You don't have income to pay for anything. So that's another negative thing. Obviously, you have your SG&A, another negative as well. You produced more revenue, but you made less money with that more revenue that you made. So, I mean, there's just another negative. And then you come up to here and you look at your cash position of $784 million, you got $26 billion in debt, and it's growing. Even though you did add some income or your inventories, you're still growing your debt position. And then you come down here, you add it, your total current liabilities, total non-current liabilities even grew a little bit as well. So, I mean, there's just a lot of red flags here that just suggest to completely stay away from this stock. But let's hop over to the financial spreadsheet here that we have and look at our trends of our financials. And you can come over here. Revenue has been just very steadily growing, but very slowly at the same time. Gross profit, very flat. Net income just hovering around 0. We come over here to net income. Typically, it seems like they've been making about $4 billion per year. But as of lately, they've not because of that litigation issue that they have. And margins here, we can see margins last quarter are confirming that we are continuing to slip into lower gross margins, and net margins are doing the exact same thing. Even though some of these net margins last quarter still might have some lawsuit coming out of their net income, but still seeing negative net margins here, not good. And then we come down here to our cash and short-term debt, or just cash to debt position. We can just see on the chart here that the company just never has any cash, but their debt just continues to climb and climb and climb and climb. So not looking, it's just not something to get too excited about. And you got your free cash flow declining, you got your capital expenditures increasing, share count is leveled off. You're not seeing any more dilution, but you're not seeing any more buybacks either. Obviously, they don't have any money to buy back shares. And your dividend continues to grow, which doesn't, a lot of these things just don't make sense. How can you continue to grow your dividend when your cash flows continue to decline? So I think this company put themselves into a pretty poor financial situation, and they've got a lot of work to dig themselves out of this hole that they put themselves in. So now let's hop over to the comps. We have Walgreens comparing to CVS, and just looking at the stock charts alone kind of gives you a pretty good understanding of what other investors have seen. And you can see CVS has held up pretty well over the last handful of years, and where Walgreens has just consistently is just locked in a downtrend. You just draw a trend line here. It's not going higher, and CVS is kind of flat. So come down here and compare these two companies to one another. We got our market cap to revenue, and revenue, gross profit, net income. And we can just kind of compare everything here. We can see our margins, but operating margin here, CVS positive, profit margin here also positive on CVS. I think this gross margin is actually incorrect. I think they got positive gross profit. Yeah, see, gross margin is actually 16%. So this particular chart is actually incorrect. So they actually have positive gross margins, positive operating and profit margins. And then we come over here for free cash flow, $11 billion in free cash flow. Return on invested capital is positive. PE, you're looking at a 12 PE on CVS versus 38 on Walgreens. And earnings yield sitting at 8.2%. So the other thing too is you look at the dividend yield. You're sitting at 3.22 on Walgreens or on CVS, and you're sitting at currently 3.88 on Walgreens. So the difference in yield is 0.6%, but you're looking at a company that's actually putting out positive numbers. You got positive free cash flow that can cover its current dividend. So definitely, probably CVS is probably the better pick here of the two companies. But let's move into the valuation here on Walgreens. We're sitting at $5.68 per share for valuation for the Peter Lynch valuation. Multiples comparison, comparing it to CVS, sitting at $7.98. We got Graham's valuation $15.70, and our dividend discount model sitting at $26.40 per share. So we come over here to our discounted cash flow valuation, and they're currently negative on free cash flow, so this valuation method won't be accurate for us. So we put a 0 in, it gives us a negative discounted cash flow price per share because they're expecting to grow its negative cash flow position. Rule 72, we have three sources of EPS growth rate, which actually a majority are actually negative, not positive. So we just say, you know what, we'll leave it at about 2.8% growth rate. That only gives them a 0.4 for doubling our current EPS. So that gives us roughly about a 0.8 for future EPS. Analysts are expecting significantly better growth rates on EPS forward looking. So we're sitting at about 90 to 80% or 90 to 85 roughly, EPS in the future here. So we're, it's about correct. We're sitting at about 8.9, whatever, 80 cents, 90 cents EPS here. But either way, we're still sitting at a fair value of $1.14 per share. So our fair market value on Walgreens is $11.38. 30% margin safety, $7.96, and analysts have a price target of $31.85. So I've got two assumptions on this one. Either number one, analysts have not revised their price targets yet after their earnings report last week, or analysts are going to keep their price targets higher to make people think, those that aren't actually going to look into the financials of the business and just see that, oh my gosh, Walgreens really cheap, I think their dividend is going to come back, whatever, that they're going to leave their price target high, so that way your retail traders start buying into this stock and getting this stock, push the price higher, as hedge funds are going to start selling into the retail traders to get out of this position. Those are my two assumptions on that. But if you just take a quick peek at the financials, it was a pretty quick no-brainer. So then we hop over here to our stock chart, and all the way back to 2015, 2016. Company has just been in a downtrend. Every time it touches this blue line, pulls back to the blue line. Comes up, pulls back, comes up, pulls back, comes up, pulls back. So it just is making lower highs and lower lows, and is consistently doing it for the last 8 years, 8 years actually. For the last 8 years, Walgreens is just making lower highs and lower lows. So that kind of gives you a pretty good indication of where Walgreens could be headed in the future. And based on their financials, if they can't turn their financials around really quickly, I would not be surprised if we see them file for bankruptcy in the not too distant future, honestly, just based on their financials. And that's assuming if nothing changes, if they cannot figure things out and things don't get better. They could borrow more money, but they've already got so much debt that how are you going to pay back all that debt? I mean, eventually you got to look at that way too, is like, eventually you got to start paying down your debt because people are not going to lend to you anymore. So they're going to see this company as a high risk business, and they're not going to lend them any money, or if they do lend them money, it's going to be a very high interest rate. So that is kind of my take on Walgreens. If you found value in this video, drop a like, subscribe, and comment. We'll be back later with another stock analysis video.